Okay, everybody. So this month we're going to take a look at something that I've talked about previously. So if you have been listening to my podcast and webinars, things along those lines, or you've been a client for a while, you know I've mentioned this numerous times. So it just feels like over the past few years we've just kind of been in an economic funk. Things haven't been too bad, but things haven't been that great, and everybody still has the remnants of 2008 in the back of their mind. And they also remember that housing bubble that happened. So, what is it? Why do we feel this way? What is going on? Why can't we get to the point where we're actually getting some serious economic growth? Why are we just seeing 1 to 2% growth? Why does it just feel so lethargic? Well, in a word, debt. Debt is something that can enhance an economy for a while. But then once it gets to a certain point, it becomes a noose around the neck. It really does. And this is probably the best chart to show you what's been going on in the United States as far as our debt levels. So this is nothing more than the total US debt compared to our GDP. So total US debt is going to be individual debt, corporate debt, and government debt. And of course, GDP is gross domestic product. So it's basically the size of our economy, all the goods and services produced in our economy. So you can see there's really two clear peaks for this chart. And the first one being in 1933. Of course, we all know that period was the Great Depression. So at the peak of the Great Depression, we had 3 times as much debt as we had economic activity. Now, really, a lot of people argue the Great Depression started in 1929. And by that point, we were already at about 225% debt to GDP. And it continued to escalate, even though debt was being liquidated. It continued to escalate because the economy, the GDP, was shrinking. So it peaked at 1933 at 300%. And then it started to decrease after that, even through the World War. And what's always funny is you always read about how after World War II, the government was deathly afraid that the depression was going to start back up. Now that stimulus, right, the government stimulus known as war, once that was done. But what happened was the economy just boomed. Now, part of it is the fact that every other competitor we had, their economy was in shambles. Certainly nice when you wake up one day and every one of your competitors is their factories have been destroyed and yours are fine. But the second thing was the debt level had come way down. So now all of a sudden they had a much better backdrop for an economic expansion. And then of course through the really the late 70s, 80s, 90s up until through the housing bubble, we increased our debt load. And we reached a peak in 2009 of 383% debt to GDP, $3.8 of debt for every dollar of economic activity. Now we have come down quite a bit since then. So if you look from 09 to 2015, we've come down to 323%. But remember, at 323%, we're still 23% higher than the peak of the Great Depression. So until we get this level down, we can probably still expect kind of a funky, slow growth environment. And this chart kind of shows over time what's happened with debt compared to GDP on a per capita basis. So on a per capita basis, debt has been just exploding since the 90s, whereas GDP growth has been pretty consistent. Nothing expansive, nothing incredible. It has been growing, but it certainly hasn't been keeping pace with debt. And so why is debt bad? Well, it's a couple things. First, it creates malinvestment. What's malinvestment mean? As you can probably tell, it just means that you're ineffectively using your capital. So for instance, let's say there's 5 companies that do widget manufacturing. And really we probably should have 2, maybe 3 of them. Well, because of debt, if access to debt is easy, then there are companies who are living on debt being able to fund operations on debt, but they're really not a viable company. They're not well run. Their marketing's bad. There could be a million reasons why. So these companies tend to continue on just off of debt. Now, a lot of people might say, well, that's good, right? They're employing people, they're buying stuff. Well, certainly it is good in that respect. You do have some economic activity from the debt, but at some point, the debt's going to go bad. And that's when things get bad. The other reason that it's not good is when you have several entities getting access to the debt markets, the companies that would be able to utilize that debt much better might end up having a difficult time getting there once the debt bubble bursts. So, of the five widget companies, the two or three that are legitimate, once the debt bubble bursts, and they always do, those companies might have a tough time because the banks all of a sudden are insolvent. So now they can't access the debt market. And maybe companies that are viable, that would be solid companies, end up going under because they can't get access to debt. Second reason that that's bad is there's something called a debt multiplier. You hear economists, especially guys like Paul Krugman, talk about for every dollar of debt that we have, it produces $3 or $4 of economic activity. That's just it's just bunk. Now, if you look at the charts, and we'll show some more, if you have low debt levels, actually there is a debt multiplier. If you have a very low debt, it does help. But once you get to a certain level of debt, at that point, your debt repayment is so much that any additional debt really is more of a nuisance than it is any kind of benefit. So the third reason, and this is the biggie, that debt is bad, eventually it leads to debt deflation and asset price declines. This is what everybody's all afraid of. So again, you have too much debt. People, companies that shouldn't be getting access to the debt are getting access to that. You had the people buying $400,000 homes who were lawn mowing jobs back in the housing bubble, and then you have it with corporations. So at some point, what happens is the debt becomes too big, and you have to get rid of it. You have a debt bubble burst. So if you think about it on the individual level, it kind of makes sense. So let's say you have a family. The family starts to use credit card debt in order to fund various purchases. So at first, it is a debt multiplier, right? All of a sudden, if they're making 60,000 a year, they could really spend as if they're living on 80,000 a year. They buy a new car. They buy all kinds of new appliances. They've got the top of the cable packages, all this good stuff, and they're accessing debt. And it really doesn't cost them all that much at first because remember, with credit cards, the way it works is all you're doing is paying 2% of the balance every month. So at first, you can increase your standard of living without having to make any additional income. But of course, we know that when you use debt, all you're doing is you're pulling future consumption into the present. So at some point, you continue to build debt upon debt, and you live this lavish lifestyle beyond your real income. And all of a sudden, that 2% becomes a burden, to the point where you can't make the payment. So now you have zero good solutions. This is where debt deflation comes in. So at that point, you have three options. One, you drastically cut your spending so that you can pay that bill. So now all of a sudden that you're spending your $60,000 income, you're really spending like you're living on 40,000. So you have to find a way to do that. The second thing you could do is you could sell assets in order to cover that. So now all the nice little TVs that you bought, the nice car, some of the little things, you got to sell them. You sell them to make sure that you can pay your debt. Well, of course, if everybody is trying to sell assets at the same time, what happens? Prices decline. And that's what you see a lot of times when the debt bubble finally bursts, especially with stock markets. The third option that you have is to default. And either way, that leads to both debt deflation and asset price declines. So all three choices are bad. And what we have right now is an economy overall that is facing that kind of debt deflation environment. So again, debt doesn't produce long-term growth. It can be a nice little boost in the short term. So as I mentioned, if you have a low debt level, adding debt could actually increase short-term economic activity. So again, buying the new car, getting some TVs, getting the full package on your cable, uh, Comcast and all that. So this chart kind of gives you an idea of after World War II, when debt levels had come way down, when they started adding debt, they saw an increase in GDP of $4.61 for every dollar spent. This is what guys like Krugman, they always use this as their example right after the war. You always hear the $4 mark. You know, every dollar debt adds $4 economic activity. This is why they want the government to spend and go into debt. They say, well, if the government spends $1 million, it's going to create 4 to 5 million of economic activity. But you look at what happened through 1953 to 84, 85 to 2000. You're actually every dollar of debt was producing less than a dollar of economic activity. And now we're at the point where every dollar of debt really does nothing for the economy. In fact, all it does is it just adds to the burden that we've already got. And of course, the government's probably the biggest to blame in this whole situation. This is just basically showing median household income dating back to 1970 compared to government spending. The government is spending way too much, and the government is the most ineffective organization out there. So every dollar they're spending is being spent much more inefficiently than you'd see on the private economy. And for those who think that, hey, maybe, just maybe, the rest of the world's in a better position, well, think again. This is this is an issue that we've got worldwide. Every country almost is facing this kind of situation. Now there are some countries that do have some fiscal restraint, but some of the big ones, the real, the Japans, China, UK, you've probably heard of the pigs in Europe, which is Portugal, Italy, Ireland, Greece, and Spain. All these countries just have massive amounts of debt relative to the size of their economy. So they're all kind of facing the same economic funk that we are. And many people look to the Federal Reserve to try to get us out of this mess. Now, I think the Federal Reserve caused this. They artificially manipulate interest rates. So they have induced entities, whether it be corporations or individuals or the government, to take on more debt than they should. So, anyway, what they have done after the housing bubble burst, which was really nothing more than a debt deflation, it was a debt crisis, not a housing crisis. It just happened to manifest itself in housing. But what you saw was the balance sheet of the Federal Reserve exploded. It was typically around 800 billion for decades, all high quality treasuries. And then after that, it exploded. And right now it's close, their balance sheet is close to $4 trillion. So they've injected about $3 trillion into the economy, but yet we still have kind of an economic funk going on. And the big reason is the Fed is trying to solve a solvency crisis, a debt crisis with liquidity by throwing money into the system. Well, throwing money in the system has done a nice thing for risky assets like stocks and real estate, but they've done nothing for fixing the underlying economic conditions. And the Fed knows nothing else other than liquidity. And the bad thing is, if we face another true debt crisis, the Fed has already shot most of their bullets out. We're darn near 0% rates. Some central banks like Japan and Europe are going to negative interest rates, which are going to have some serious consequences down the road. So we're facing really no good situation until we start to get our debt under control. In fact, I've always been saying we're essentially turning Japanese. Japan has been in an economic funk since 1990. And if you look at the reason why, they have been dealing with a debt level and have not had any effort to bring their debt level down. The blue line is private debt, and you can see it actually did come down from a peak of 273% 96, and now it's at 113%. But unfortunately for them, the government picked up the slack and has gone from a very healthy 52% debt to GDP for the government in 1989 to now being close to actually 200%. So they've done nothing to address the underlying condition, and they have been in an economic funk now for over 25 years. So, are we destined to do the same thing? Well, if we don't address the underlying condition, then we probably are. So, what should you do as an investor? What's kind of the optimal investments? Now certainly there's going to be short term investments in all of these, but what you're going to find longer term is things like long dated high quality bonds are going to pay pretty well because in debt deflationary environments, despite the fact that the Fed or other central banks are pushing in liquidity, for the most part, you have a deflationary environment. That's what debt deflation does. It affects asset prices, it affects debt levels, it affects economic activity. So, in those situations, long dated, high quality bonds are typically some of the best investments. Precious metals also tend to do pretty well because the central banks will react with massive amounts of liquidity. It does put pressure on the underlying currencies. So, people tend to move to what they see as safe havens, and precious metals is often that investment. The other big thing is you have to be very careful with your stocks. You have to look at things that are going to pay you dividends. So dividends become a much bigger part of your return. And you also want to get very low cost value stocks. You don't want to be buying high flyers in these kind of situations because usually you're going to see more volatile markets. So you want to buy high quality stocks. That's probably your best bet for these. Now, the timing of all three of these investments certainly fluctuates, but from point A to the end to point B, these will probably do much better in a debt deflationary environment than many other kinds of investments. So that basically hits on very quickly the big reason we're in an economic funk. Now, I'm going to look a little bit more at some reasons why this funk is continuing. We're going to look at the Federal Reserve as well and how they're kind of causing this. But we'll do that in future. We'll try to keep these pretty short. But if you'd like more information, you can go to our site, picketfencefinancial.com. We have lots of videos on the site. We also have a way where you can sign up for our newsletter. And again, if you ever have any questions, please email me. I'll be happy to address them. Thank you.